It has never been easy being a value investor in a bull market, of course. What's different this time?
Well, this time it's been very interesting that the cheaper stocks have actually been underperforming in down markets. You know, my entire history of the last 34 years, if you had low PE stocks and the market went down, those low PE stocks would outperform and then not do well in an up market. More recently, it's been kind of the opposite. And that's been very, very strange to me to see these cheap stocks underperforming on down days.
Why is it happening?
You know, I think some of it has to do with the sectors that, the cheaper stocks are kind of a lot of times right now in the cyclical industries and in the financial services industries. So those are industries that maybe people don't perceive will do well in a declining market or if the economy sort of takes a downward turn. So I think that's why that's happening. Mm-hmm. Also, those stocks didn't do well when the financial crisis happened, 9 years ago. So I think that there are some people think it's going to repeat itself in the same way, which is not necessarily happen every single time.
No, it doesn't necessarily happen every single time. Do you think it's going to happen that way?
I don't. I think those of us that stay with tried and true value stocks, good companies that have strengthened their balance sheet since the financial crisis, have made some of the appropriate diversification moves, will do surprisingly well in this downturn and will outperform substantially as some of these large cap growth stocks finally have their comeuppance. A lot of them have gotten, I think, way too expensive.
Well, let me ask you this question first, before we get to when that's going to happen and why. Is passive investing partly to blame for what you've noticed?
I think it is. I think passive investing is taken off like I've never seen it before. And
well, like nobody's ever seen it before.
Yeah, it's just been crazy how the ETFs, of course, have exacerbated the indexing phenomenon, throughout the world. And I think what's happening is people are pouring more and more money into passive investing. It's become the thing to do. And so people, these index funds are buying the same stocks. As they get more money, they push up the same stocks higher and higher and higher. And
not by choice, they have to.
They have to buy them, right. But now it doesn't matter what the values are. And I think whenever I find a market where people are buying stocks irrespective of the valuation, irrespective of PE multiples, just buying them because they've been going up and become a larger part of the index, that always ends badly.
And we can see here the growth in passive instruments versus active, very noticeable. I don't want to overinterpret what you're saying, so let me put it to you in the form of a question. Are passive instruments and ETFs in particular distorting the stock market?
I think it is I think they are temporarily distorting the market because they're distorting individual securities. If people buy the same names that are the big weights in the index and push them higher and higher, irrespective of the fundamentals of those businesses, well, then that's not going to be able to last for the long term. This really doesn't make sense.
Is that why value is so out of favor as a style?
For sure. As people buy these expensive stocks, the indexes take over. The value stocks are what I call orphans these days. Just sort of left out. They become smaller parts of the index. Less and less research is being done on these companies. They're just neglected orphans.
Well, what about the fact that a lot of value managers are underperforming? That surely has to play a role as well.
Right. It becomes a self-fulfilling prophecy in the short term. But, we've learned over all these years that once everything becomes a common trend that everyone believes in, everyone thinks passive is going to boom and thinks these orphan value stocks will underperform, once that becomes the sort of the conventional wisdom, it never plays out that way.
So you're as confident as you've ever been that value investing is the right approach, or have you had to change some of your assumptions or perhaps some of the philosophy that underpins what you do?
We do exactly what we've always done. We want to buy cheap stocks that are selling at substantial discounts to the private market value in the analysis that we do, and low PE stocks. And we still believe in that as strongly as ever. But we have learned you want to make sure those companies have strong balance sheets to weather whatever storms happen. And we learned that during the financial crisis. If your balance sheet wasn't a fortress-like balance sheet, you could be surprised with how much downside there was.
You've been at this, at least at Ariel, for 34 years. And longer if we include your career before that. Relative to what you've seen, John, how would you characterize the stock market right now?
Well, I think it's an interesting time because I do think there are some pockets of opportunity that are really special. And I think if you do your homework now, it really can pay off. And you look for these names where they've just been neglected and misunderstood and sort of left out. I think this is really a fun time. It's a fun time to be doing research, a fun time to be thinking about industries and thinking about sectors where there could really truly be some hidden gems there.
At the same time, active managers like you face a number of challenges, right? Hurdles, we could call them. There's fee pressure.
That's right.
Equity market structure can, at times, make your job more difficult. The second-order effects, I'm sure, from the Department of Labor fiduciary standard that you're beginning to experience. What do you find most challenging?
Well, we do find it challenging that a lot of our institutional clients are indexing their domestic equities. So you get calls from clients who said, we're indexing everything, irrespective of your 34-year performance. We don't care. We just have given up the ghost, and we're going to index everything. That's extremely challenging. Also, of course, as you talked about, the fee compression is real. And so we're having to negotiate fees and having to make sure that you're living within the current fee structure. Otherwise, that can be another reason you can lose an important account.
Have you had to cut fees as a result?
Over time, we've definitely seen our average fees go down. And that's something that Melody Hobson, our president, works really hard on, and we work with our board to make sure that we are staying within the norms in our industry, because we don't want to be outside of the norms. And we had board meetings last week, and we were talking about that with some of our board members.
What are they saying?
They're saying, you've got to be, at the average or lower. You can't hold out for higher fees. Even with your outstanding long-term performance in this environment, fees matter so much. You've got to make sure you're on the lower end of the fee structure. So we've been ratcheting back our fees, our international and global funds. We've ratcheted back our fees to make sure that we are competitive and more than competitive.
Is that a trend that is going to continue, or do you see a point where it stops? I looked, for example, at your flagship fund, the Ariel fund, which you manage. It's got an expense ratio of 1%. If you were to cut that in half, let's say, to 50 basis points, what would happen?
Well, it would make it harder for us to do our job, that's for sure. But
would it attract more assets? Would it help those clients who, as you've described, have been going to 100% passive on domestic equities from leaving?
I don't think so. No, I think that there's really two camps. There are people who believe now indexing is the end-all and be-all, and those that still feel there is a place for the old-fashioned stock picker, the John Neff, the Peter Lynch, the Mario Gabellis of the world that go out and do this homework, and they're worth paying for. So you wouldn't find that people, I think, would make a decision based on a few basis points in this environment. It's kind of all or nothing. What
do you think it's going to take to trigger a shift in fund flows back to active from passive?
I think what will have to happen is you're going to have a major correction, and these high-flying, large-cap growth stocks that are making up such a big part of the index, when they collapse, it'll be what happened before at the end of the century, when this happened before, and the
dot-com bubble.
Yeah, you had the dot-com bubble, the S&P collapsed. Those of us in the value investing really had an extraordinary time outperforming, had our day in the sun. That'll happen again.
When you say major correction, we're talking about something in what magnitude?
Well, I would think your overall market, you could see it down, 10 to 15%. It's been a long, long time since we've had a correction. But one of the things I've been telling everyone, and on some of the investment committees that I'm on, markets are going to correct, but they don't have to correct like they did in 08 and 09. I think sometimes people have put all these belt and suspenders on their investing. They become so risk averse because they think every downturn will end up like the collapse of 08 and early 09. And that's not necessarily so.
Do you believe any of the hype or any of the rationale that underpins the valuations on the FANGs, right? The Facebooks, the Amazons, the Apples, the Netflixes, the Googles, or for that matter, any other hot stocks right now?
I think they're going to be higher multiples because, as Warren Buffett says, these companies don't have to put a lot of capital out to be successful. They don't have to raise a lot of capital. They generate lots and lots of cash flow. They have high returns on capital. So I think they deserve a premium, but the premium's gotten too large because of this indexing phenomenon. So I do think they will have a significant correction also.
John, before we finish up, you've been on a mission for years to make the money management industry more racially diverse. Yet, it appears that portfolio managers are still overwhelmingly white. Why?
I think that's because people have, traditionally, people of color have not been as exposed to the markets as others have, and so the pipeline isn't as large. But at the same time, I think there are people who are comfortable hiring people that they know, hiring people from their own communities where they've grown up with, and not realizing there's this extraordinary talent throughout the country in diverse neighborhoods, people of color who can do very well and women who can do very well investing.
Is President Trump making your job harder?
Oh, see, making the job hard, it gives us a lot of sleepless nights. We do worry about what's happening internationally, and I know that's something that you have to worry about because, you know, war, of course, would be a horrific thing if we got into an unintended war because of the kind of leadership we have in Washington today.
I was thinking more along the lines of his comments about the violence in Charlottesville, for example.
Yeah, well, those comments were, as we know, were horrific, and were really the kind of thing that you just don't want to ever see in this country. We've come so far, and to be able to position that kind of an issue the way it was positioned, it was just totally wrong. And I think things are going to get back to normal, though. I do think eventually our country's coming together. People know those were not the right remarks.